Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman. JC.
Back in the studio office, Dio.
Yeah, it's good to have you.
Yeah, likewise. You know, last time we were out on a golf course, I think. No,
we went to Topgolf.
That was awesome.
Hung out with Eric Ducharme.
Yes.
Yeah.
Shout out, Eric.
Shout out to Eric. How about shout out to Topgolf Corporate?
Right. Shout out Topgolf Corporate.
Yeah. I mean, hopefully we can parlay that into like lifetime memberships or something.
I mean,
but
if you put it out there, it might happen.
If I put it out there, it might happen. You know what I was thinking about?
Okay.
About that episode. And then I promise, by the way, ladies and gentlemen, boys and girls, today's episode you're going to want to listen to. You've probably clicked the link already. You saw the title. But it is going to be diving deep into the Fannie Mae changes as it pertains to the 7% rule, as it pertains to investment properties and second homes.
Okay.
And I'm even going to geek out a little bit about some other changes that are kind of flying underneath the radar.
Yeah.
That if you're a loan originator or you're a home buyer or you're a realtor, or you know a realtor or a home buyer or someone who's going to be obtaining a home loan, you're going to want to know about these Fannie Mae changes as well.
Nice.
We're going to talk about the history of it, why it is, and where it's going.
Perfect.
But no, real quick on Topgolf, I thought it was a great idea. And
Yeah.
you always talk about the universe if you put it out there. Because last episode, if you didn't get a chance to check it out, and by the way, you can check out our episodes on YouTube.
Yep.
You can check them out on Spotify.
Yep.
You can check them out on Apple Podcasts.
Yep.
And really anywhere else that you can consume podcasts, we're
Correct.
there.
Correct.
But you can listen to us on Spotify and Apple. You can watch us on YouTube.
Yep.
You can also comment on YouTube, which is a lot of fun.
Yes.
And today's episode is actually coming from a couple YouTube comments.
There it is.
So we call them viewer request or listener request.
Yeah.
And then obviously our social media, we're on Instagram, LinkedIn, Facebook at The Loan Officer Podcast. And if you ever want to find me, I am Dustin Owen on LinkedIn. He's John Coleman on LinkedIn.
Yes.
All right, we got all that done.
Got it.
Yeah. But no, what I was trying to put out in the universe for our friends, now we call them friends over at Topgolf, is how cool would it be to put like your face and my face on the back of like the little buggy or the little cart that
picks up the balls?
Yeah, that picks up the balls. And then like they gave a free beer, not any beer, an IPA.
Yes.
A free IPA
Stout.
if you hit our
I
faces.
think it's worth it.
Wouldn't that be funny?
Yes.
So Topgolf, if you're listening, if you're like, really love the episode we did on location at one of your
For sure.
at one of your venues, you should maybe take it a step further and entice your participants to shoot for JC's face, to shoot for my head. And if they hit us, and it's a moving target, right? Because it's going to be on the back of that little, I don't know what you call that machine, the ball picker-upper?
Yeah, there's a proper term for it, but
yeah.
it escapes me now.
It's like the Zambroni of
the Zamboni of golf.
There you go. All right, so today's episode, we got all the fun and humor out early.
Now it's serious.
Now it's the serious stuff.
Okay.
But, all right, John.
God, here we
You
go.
haven't been under a rock, have you, the past 2 weeks?
I haven't, but I've heard Fannie Mae has changed some guidelines that might interrupt the flow of work for loan officers in the mortgage industry.
Yeah, so check it out. So Fannie Mae, now this isn't like Fannie Mae woke up and said, hey, we want to be like the big bad guy today and make everyone in the mortgage industry angry. Okay, Fannie Mae's been under conservatorship for the better part of the past decade plus. They're under conservatorship because they, along with their stepbrother, Freddie Mac, basically went belly up during the financial meltdown of 2007, 2008. They couldn't handle the amount of loan losses they were incurring. Therefore, the federal government had to step in. The Treasury had to infuse cash into them, and they put them under conservatorship. So the conservatorship that they've been under as the agency is the Federal Housing Finance Agency, or we call that FHFA. So FHFA was, and it's important that people understand the history of Fannie Freddie and the history of conservatorship to understand why what has transpired, and then we'll talk about like how we can pivot, adjust, and move forward.
Perfect.
Okay, so the FHFA was created when Fannie Mae and Freddie Mac were put into conservatorship. They were only put into conservatorship because they had to be rescued after the financial collapse, and they had to have cash infused with the Treasury. So just recently, the FHFA, along with the Department of Treasury, they have the Senior Preferred Stock Purchase Agreements. Okay, this is basically, without geeking out too much and diving too deep, this is all part of Fannie Mae being put into conservatorship. the Treasury having to infuse cash, and ultimately, we as a country have been working towards trying to get Fannie and Freddie out of conservatorship.
Okay.
How do we make these more private and less government entities?
Okay.
It's recap and release, recapitalize and release. That's been a term within the mortgage industry for the past decade.
Okay.
I don't think when Fannie Mae and Freddie Mac were put into conservatorship, it was thought that a decade later they'd still be there. But what has happened is the private market has not stepped up or stepped into the game. Okay, so if we were to go back to 2004, 5, and 6, and then any time period before that, you would have seen that Fannie Mae and Freddie Mac probably, and please don't quote me on this, I'm trying to give it very high level, but Fannie Mae and Freddie Mac probably, were less than 30%. They were backing less than 30% of every mortgage loan that's currently being originated.
Okay.
Well, over the past decade plus, the government, whether it was Fannie and Freddie through being in conservatorship with the FHFA, or the A loans, the government loans, USDA government loan, VA government loan, FHA government loan, government lending has been like 90 to 95% of all loans being originated.
Yeah, that's all I know in my.
Yeah. So that's a very high percentage. When if you go back to pre-bust, pre-economic collapse, it was closer to like 30%.
Really?
Yeah. So, and the reason why is because there used to be a private market. We call that today PSL or private label, PLS, private label securities. Okay. There were companies like Morgan Stanley, like Merrill Lynch, like Deutsche Bank, like JP Morgan Chase, like Wells Fargo, that they were creating their own mortgage-backed securities, and then they were trading those into the marketplace. Currently, that's not being done. The mortgage-backed securities being traded are not private label, they're government label. They're either Fannie, Freddie, which now has been combined into a unified mortgage-backed security, or they're Ginnie Mae securities. So, kind of even got more geeky than I wanted to. Just know this, very high level, because we need to get into what this 7% rule is, what it means, how it's going to impact our business. What you have to understand is that Fannie Mae and Freddie Mac were never designed to be the only player for conventional financing. They weren't meant to be the only takeout for banks to deliver their loans to securitize their mortgage-backed securities and deliver them into the market. But for the past decade, they have been. Okay? So Fannie and Freddie, and this is all through their conservator, FHFA, they've had to determine, well, how do we get the private market into it? They're not coming on their own. What do we need to do? Okay, here's what I think we need to do. This is not Dustin Owen. This is Fannie and Freddie or the FHFA talking, right? Okay, well, let's make it increasingly difficult for consumers to access some of our products. Well, what products do we not want to touch? Well, we don't want to really screw with a whole lot people who are buying homes for their primary residence. Like, we want to promote homeownership throughout the U.S. because we understand that homeowners are 70 times more likely to become wealthy than non-homeowners, right? We've understood that. But what are some avenues that we really need to see the private market step up to the plate? Well, should a government agency or an agency that is in conservatorship, such as Fannie and Freddie, be supporting people as they become landlords, as they grow a real estate portfolio? Well, the FHFA and their agreement with the Department of Treasury, they've determined, no, that's not the highest and best use of our resources. Therefore, we need to restrict the amount of loans that we are securitizing that are backed by investment properties. And then they take it one step further and they said, should we be promoting people buying vacation homes, second homes? Well, not really, right? That's maybe not in the spirit of what Fannie Mae and Freddie Mac were originally designed to do. Because people who buy second homes, they tend to be more affluent, they tend to be more wealthy. They've kind of already made it. And we want to utilize our resources to help people that maybe don't have generational wealth or want to create generational wealth, and they want to do so through home ownership. So they have limited, like part of this senior preferred stock purchase agreement states, and this is the agreement that's set forth between the Department of Treasury and the FHFA, they've determined that only 7% of the loans securitized by Fannie Mae can be loans backed by investment properties and second homes.
How do they determine which 7% get?
Well, that's a great question. First, let me just let you all know this.
Okay.
We've been over 7% since 2013. Damn. Okay, in 2013, by the way, that's when things started to come back, right? Like things crashed in 7 and 8. They were pretty much rock bottom 9, 10, and 11. Mm-hmm. We started to rebound in 2013. Okay, so in 2013 was the first time that Fannie Mae was securitizing more than 7% of the loans were backed by second homes or investment properties.
Gotcha.
Your question is how or how do they determine
the 7%?
Well, so this is kind of crazy. It's not clear. It's not concise, and this is one of the reasons why our advocacy groups, the MBA, the National Association of Mortgage Bankers, Urban Institute, and others, are lobbying and asking for more clarity from the FHFA, from the Department of Treasury, because it's looked at as over a 12-month period of time, and it doesn't necessarily state that Waterstone has to deliver less than 7%, or that Wells Fargo or that guaranteed rate. It just says that Fannie Mae can only have 7% of the loans of that back their mortgage-backed securities be loans made for investment properties and second homes. So here's what we've seen on the street level. If you're an originator tuning in, hopefully you haven't tuned out because I bored you with some of the geekiness, but it means this. Or if you're a potential home buyer and you're tuning in, this is the meat and potatoes that you need to understand. Pricing on loans that are backed by homes that are being purchased or refinanced that are second homes or investment properties just got mad expensive.
Really?
Like I'm talking 0.5% more expensive, a full percent more expensive. Yeah, it's like anything in life. If you have a product that you don't want to push,
you just jack up the price.
Jack up the price. Make it more expensive.
So is this a situation where like the pendulum tried to course correct and corrected too much, and now we're like, whoa. Now we're trying to...
Could be.
Okay.
Could be. Yeah, I mean, it's like anything in life. Only time will tell.
Yeah.
Only time will tell. But yes, if you read some of the information coming out of the Mortgage Bankers Association, if you listen to what's being requested out of the National Association of Mortgage Brokers or what's being written by the Urban Institute, yeah, those folks are very fearful that this is too much too soon. Mm-hmm. Right? There's no denying that at some point we have to pull our mortgage industry off the government teat.
Yeah.
Like we need to wean ourselves off of it. But is this too much too soon? Some people, like Mark Calabria, don't think so. Right? Others say, I think we're doing this too quick. But ultimately, what's trying to be done is we're trying to entice the private market to come in. We're trying to entice players that have been sitting on the sidelines for the past decade plus because they see mortgage as too risky with too little reward to enter into the space.
Oh, okay. That
makes sense, and that's right. Life's about risk versus reward. If the reward is high enough, I'll take the risk. But if the reward is too low, I won't take the risk. And part of regulation that came from Dodd-Frank was the answer to the financial collapse that was caused by the banking and housing industries, primarily. Then this new regulation and legislation made it more cumbersome to lend. It made it more taxing, more compliance heavy, and it just was determined. Look, mortgages, especially, but the mortgage industry, too risky for too little reward. So with Fannie and now Freddie following suit, basically creating a scarcity, meaning they're not going to be allowing as many of these loans to come in and fill their coffers. Then what has happened is everyone who's trying to originate these loans, they're only going to be able to originate them at a very high premium. So you saw self-imposed aggregators and mortgage bankers put these loan level of pricing adjustments into their pricing, basically make pricing more expensive. The hope is that let's say you are Deutsche Bank or you are UBS or you are JP Morgan. Mm-hmm. You weren't willing to purchase or create a security that only paid a 3.25% rate of return. But you would have done it at a 3.75% rate of return. But at 3.75%, you'd have had no takers. No one would have bought into your product. Yeah. No one would have sold you loans because it wasn't competitive, meaning they couldn't go out to the street and entice borrowers to come in and borrow money from them, at which they turn that loan into a security, package it, and sell it. But now with this new 7% cap, if Fannie, through their own rulemaking, mm-hmm. as determined through the preferred stock agreement or repurchase agreement and the Treasury and FHFA and everything else, if their rulemaking has now pushed pricing on those loans up to 4.25%, mm-hmm. maybe someone will come in now at 3.75. Maybe a market that otherwise wasn't created mm-hmm. has now been created. That's the end goal, right? If you look at anything that's being done trying to recapitalize and release Fannie Mae and Freddie Mac out of conservatorship, we have to get the private market interested.
Correct.
The private market wasn't interested in investment property loans mm-hmm. or second home loans when the interest rates were 3.25%. But they darn sure would love maybe some if the interest rate was 3.75. Well, the minute Fannie Mae reduces, maybe even goes as far as cutting in half the number of loans that they're willing to accept, there's a supply and demand issue, right? Anytime that there's mad demand for your product or your service, do you have to offer it a discount or can you offer it as a premium? As a premium. So in this example, just imagine if Fannie went from offering investment property loans at 3.25%, mm-hmm. now all of a sudden, because of these new rules, they're at 4.25%. Yeah. Maybe someone like a JP Morgan or a Morgan Stanley or a Merrill Lynch or a Deutsche Bank, maybe they'll come in mm-hmm. at 3.75. If they do so, then originators, don't freak out.
That's what I was about. That was my next question.
Don't freak out, right? The private market may come in, and if the private market doesn't come in, which is a fear, right? That's a fear. Then what happens? Now, there's going to be some non-QM lenders out there, right? Lenders like Citadel or Angel Oak or Sprout, or that maybe they'll create a product. Mm-hmm. Now, that product's not going to be as advantageous as a Fannie Mae 30-year fixed mortgage in terms of its terms and its rates, but it at least would be a solution. Like at the end of the day, as an originator, even as a consumer, whatever's available, we're going to market and sell.
How long do you think the timetable is for something like this? For like, all right, so Fannie Mae, they did this thing. How long do you predict it will take for like other people to come in the market and offer new products? Like 3 months, 4 months, 5 months?
Yeah, I have no idea. I think that may be a little bit above my pay grade. Okay. Like I could take my guess.
Yeah,
right?
Give me a guess.
There's people already trying to get in.
Okay.
Right? There's people. Look, this isn't new news, by the way. Let's stop there. Okay. This isn't new news. I mean, since at least 2018, if not 2016. Okay. The FHFA has been forecasting. They've been prognosticating. Okay. They've been giving warnings. Like, hey, we're going to be doing something like this. Get ready. Get prepared. Yeah. Right? This isn't brand new. So yes, there have been people that when this news was announced just a few weeks ago, it wasn't necessarily new news. It was more of a, like imagine, I don't know, back in high school, your buddy's like, yo, John, one day this week when you're not looking, I'm going to come and I'm going to rabbit punch you.
All right, sure, man, whatever.
Yeah. And then then you forget about it. And then like Thursday, hey, man, bell rings. Yep. Yeah.
Hey, what'd you do that for? I told you I was going to do it.
Correct. Yeah. Gotcha. It's like, oh, shit, he told me that was going to happen.
Gotcha, okay.
I didn't think he'd go through with it. No, guess what? They're going through with it.
Okay.
But here's what's crazy. If you like read into it, where there's a lack of clarity is Fannie Mae hasn't stated, and they might not state, whether or not it's like, hey, every lender who delivers loans through us can only have 7% of their loans be loans that are backed by second homes and investment properties. So because they haven't stated it, one could only assume that, hey, John, your mortgage company can only do 3%. But DO, we like your mortgage company, so you guys can do 12%.
Yeah.
Because at the end of the day, the rule is that no more than 7%.
So total will average out to be like, gotcha.
Yep, and it's the average over the most recent 12 months. So it's like almost like a rolling average, at least the way that I read it.
Yeah.
I read it to be a rolling average, not a calendar year. Could be a calendar year. Correct me if I'm wrong. I'm totally cool with that. I've admitted that I read it as rolling average.
Yeah.
But so like that's kind of it's almost not fair, right?
Yeah.
Well, like do we have parity then in the landscape of lending if you won't let John's mortgage company deliver but 3%, but my mortgage company can do 12?
Yeah.
And at what point are you going to start measuring it? Is it John's mortgage company starting April 1, but mine not till June 1?
Right.
You know, but what the industry has done as a whole, again, for loan officers tuning in so you understand, and consumers who are looking to maybe purchase that beach condo or that lake house or your first or your fifth investment property, it's to understand that your pricing just went up significantly. And it has nothing to do with your lender, has everything to do with the loan that you were trying to obtain is backed by Fannie Mae and Freddie Mac. And Fannie or Freddie, through their conservator, FHFA, are being told that only 7% of the loans that they purchase can be loans that are backed by investment properties and second homes. Therefore, in order to cut off that flow, you have to increase pricing to force people to not look your way.
Yeah, so they have to look somewhere else.
Yep, so you've seen pricing go up. The hope is that the PLS market, the private label security market, comes in and fills that void. Right now, the non-QM lenders, like these are lenders who have been doing the bank statement loans and some of the loans that don't meet the standards of a qualified mortgage, those companies have probably been chomping at the bit, licking their lips, salivating, getting excited because this is more opportunity for them.
Gotcha.
So if you're a loan officer and you don't have relationships with non-QM lenders, ding, 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 you might need one. This may be what gets you off the couch talking to one of those account executives at one of those lenders.
Gotcha.
Or if you're a Morgan Stanley and you've been wanting to get back into the mortgage space, or a Merrill Lynch wanting to get back in the mortgage space, but you didn't really want to do the bank statement loans.
Yeah.
Maybe you want to get back in because you want to cherry pick some of the best loans that are backed by second homes, vacation properties, or investment properties, right? Maybe you come in and say, hey, I'm going to create a private label security. I'm going to offer a rate that's 3.25%, but I'm only going to buy loans that have a 760 credit score, a 75% loan to value, and a 41% loan, DTI or below.
Yeah.
Well, if you're a lender and you know that Merrill Lynch or Morgan Stanley is creating that type of private label security, you now have to ask yourself, do I have the ability and opportunity to sell loans to them?
Yeah.
Because if I don't, I need to get in line. I need to figure out how I can be next in line to deliver loans to those people, because my loan officers would love nothing more but to have that aggressive pricing to take to the street. Like imagine that. Imagine if I'm a lender and I can deliver loans to, let's just call it Merrill Lynch, and Merrill does have this awesome private label security as long as I have a squeaky clean client that's willing to purchase loans that are backed by second homes and investment properties.
Yeah.
Well, I could deliver it to Fannie or Freddie, and it's going to be at 4% because of their new 7% rule and the loan level pricing adjustments. But this private label security has come in. It's backed by Deutsche Bank or Merrill Lynch, or you name that big banking conglomerate, and they're offering rates at 3.5%.
Oh shit.
Yeah, I want to go there. But what if you work for a lender who doesn't have that opportunity?
Yeah, then what?
Yeah, what if you work for a lender who doesn't have the ability to sell to one of these non-QM lenders?
SOL.
Yeah. So as an originator, this very well could open your eyes to being like, ooh,
That's what I was gonna say.
maybe I'm no longer aligned with the right mortgage company. Or it may solidify that, hell yes,
So I made the right move.
I made the right decision because I'm aligned with a mortgage lender who's going to allow me to be flexible. Just know that it's going to impact all of us one way or the other. We don't get to make the rules.
Yeah.
We have to play by them.
But just hearing you talk, like, even if it makes sense how you articulated today, it sounds like an opportunity more so than a debt. While it could, irritate some individuals, the way you're making it sound to me is like there's a prime opportunity to either revamp your business, do something different, XYZ.
Look, Mike Smalley talked about this when we had him on the podcast show where we talked about the new IRLA.
Yeah.
Right? Look, you either adapt with change and you try to stay one step ahead of the curve, or I think he referenced the book "Who Moved My Cheese."
Yeah.
Right. Or you defy change, you complain about it, and you don't roll with the punches. If you want to take the latter, you're going to fall behind. I like your mindset, John. You're like, no, there's going to be an opportunity here. Yeah. Does it suck? Yes. You know who loses? The consumer loses. The consumer loses, but Mark Calabria, who heads up the FHFA, he may argue the consumer will win eventually if this is what forces the private market in. Right? I mean, the more competition you have, ultimately, the better things are supposed to be. Yeah. Ultimately. Yeah. So is this going to be the catalyst? Only time will tell. How harmful will it be? Only time will tell. Gotcha. Right? It'll be harmful if the private market doesn't step up to the plate and fill that void. Right? But a question people should ask is it the government's role to help John Coleman and his wife put together a portfolio of 10 investment properties?
I would say no.
Is that the government's role to back mortgages, to bankroll you becoming a multimillionaire through home ownership? Or should you utilize and leverage private financing, private funding, and allow the government to utilize their resources for affordable housing, for first-time home buyer initiatives?
I mean, yeah, the way you say it is like,
for opportunities for low to moderate income. I mean, there's so many other opportunities. Is that the role of government? Do we want less government or more government? Well, based on last year's election, half the populace wants less 5 million, wants less government, and half the populace plus 5 million wants more government. Yeah. So it's not a we're all on the same boat, right? So you have to find a happy medium somewhere. Now, here's some other changes I do want to cover. And I know we're already getting long, and I feel like we barely scratched the surface on the 7% rule. And I feel bad because I don't even know if we actually answered the question that our viewers and listeners had when they started reaching out to us a week ago saying, guys, could you please cover this new 7% thing? Yeah. We did our best. If you have any further questions, let us know. Yeah. Like, hit John up, email. What's the email? Loan Officer Podcast?
The Loan Officer Podcast at gmail.com.
Yeah. Yep. Make comments on YouTube. If I got something totally wrong, I apologize. Like I encourage you all to become students of our industry. Dave Stevens is a hell of a mortgage professional. You can follow him on LinkedIn. Okay. He gets interviewed a lot. He writes in HousingWire. So make sure you're reading the articles that are in HousingWire. You're following guys like Dave Stevens. You're reading Rob Chrisman's blog. You're subscribing to Rob Chrisman's blog. It's a blog, but it's actually a daily email. Okay. Like these are things that as a mortgage professional, even a real estate professional, if you are tied to the mortgage and housing industry, you should be reading HousingWire. You should be following people like Dave Stevens. You should be engaged in your Mortgage Bankers Association or your National Association of Mortgage Brokers. Yeah. These are all things you should be doing so you're kind of in the know and you understand the why behind it. Like I tried my best today to say, hey, if you go back 10 or 15 years, Fannie and Freddie were not this involved in the mortgage banking.
People have memories like a goldfish, Dio. I'm telling you, because I would have.
Yeah, it wasn't designed for the government to be the end-all, be-all player when it comes to backing mortgages.
So if you go back, this is me till like 1985, you could have J.P. Morgan doing like a bunch of mortgages.
Oh, geez. 1985, John. I'm sorry. Okay, savings and loans. In 1985, the savings and loan industry, you're looking at me all perplexed. Like, what in the hell is the savings and loan industry? Yeah, well, they flopped. They crumbled. They crushed. Like, really disrupted the economies in states like Texas terribly. Okay. The collapse of the savings and loan actually would lead us into the takeoff of the quasi-government agencies known as Fannie Mae and Freddie Mac. They're always quasi-government. Like FHA and VA and USDA, those were always government entities. Uh-huh. Fannie and Freddie were quasi-government. That's how I was taught it even in 2004. Okay. Right? They were publicly traded companies that just were backed by the government, but not like wholeheartedly backed. Okay. It wasn't until the financial collapse and Fannie and Freddie, like every other lender who was heavy in the mortgage industry, were ready to go belly up, and they didn't have enough cash to cover their losses, that the Treasury infused cash into them, just like the Treasury was infusing cash into AIG and a bunch of other companies that needed the support. Okay. the Treasury infused a bunch of cash. But it's good to know, you mentioned 1985, because no, in 1985, most mortgages were being done just through the bank, and they weren't being securitized into mortgage-backed securities. But the mortgage-backed security, the reason why we need Fannie and Freddie, it creates liquidity in the market. It allows banks and lenders to continue to lend money. Because if I'm a bank or I'm a savings and loan and I lent out a bunch of money, eventually I can only lend out a percentage of the deposits I have.
Yeah.
If I run out of deposits, then I can't lend money.
Yeah.
Well, if I can't lend money, people can't go out and buy more houses. Builders can't continue to build more houses. We can't continue to grow. So we had to create liquidity in the marketplace, whether it was through the federal bank, whether it was a Federal Home Loan Bank, or whether it's through Fannie Mae and Freddie Mac and the ability for lenders to sell loans to Fannie and Freddie and get those loans securitized. Gotcha. So 85, that was a crazy year because that was right before the savings and loan collapse or during the savings and loan collapse. But just know in the 90s and early 2000s, Fannie and Freddie weren't as heavily involved in every loan that was being originated. They weren't the only player. There were other players, private players out there. After the collapse, the private players disappeared and they have yet to come back. So we as lending institutions and banks have been solely relying, for the most part. There have been some private players step up. Redwood Trust is one of them. Angel Oak is one of them. I think I got that name right. There's been other players that have definitely stepped up. But for the most part, greater than 90% of every loan has had some kind of government backing, whether it was FHA, VA, USDA, or Fannie Freddie. So, when Fannie states this, when the FHFA in their agreement with the Treasury states that this has to be no more than 7%, please know that it was never designed for Fannie and Freddie to be like the only takeout for people to order from, right? Yes, it sucks. Yes, this is going to be a kick to the gut, but we were warned of it several years ago. It was never designed to be this way. I'm encouraging you to learn it, learn why, learn where we're going. Align yourself with a mortgage origination company that will allow you the flexibility to either deliver loans to a non-QM lender or can go out and build relationships with maybe some of these private label security aggregators who are going to be creating brand new products and bringing them to the market. But make sure you understand it well enough to explain to the consumer, because ultimately the consumer is the one who's going to hurt here, because very easily or very decidedly lending to people who are looking to purchase a second home, a vacation home, or a rental property, an investment property, has just become more difficult. More expensive, and more difficult, right? Because think about what this, if only 7% can be delivered.
Top cream of the crop.
There you go. Yeah. I'm going to cherry pick. I'm going to cherry pick the good loans, and I'm going to charge a premium. Now that's going to give opportunities for someone else to come in and maybe charge less. Maybe they'll cherry pick a little bit more than I do, but they're going to do it for a lot cheaper. Yep. Or they'll charge the same rate as I do because there's now a fatter profit margin, a fatter premium, but they're willing to do so with a little bit more risk. So for example, maybe we see that Fannie, it's very difficult to get someone approved through Fannie and Freddie if their DTI is, this is, by the way, I'm segueing into the last bit of today's show, but still speaking specifically about second homes and investment properties, maybe this new 7% rule means, yes, Fannie and Freddie, we're going to charge a premium, right? You're going to see a fat LLPA, loan level of pricing adjustment, 200 to 300 basis points. That means that interest rate just went up by 0.75% to 1.5% higher than what it would have been before this change, before this new rule. And not only am I charging the premium, but I'm going to make it more difficult. Meaning when you run one of these scenarios through my automated underwriting system, I may only accept 720 plus credit scores. I may only accept people with DTIs under 43. I may only accept loan to values that are 80% or less. Okay, it is what it is. If Fannie and Freddie are the only player in town, that's all I got. That's all I can do. But what if the private market comes in? And the private market may come in and say, look, I'm going to be just as strict as Fannie Freddie. In fact, more strict. I don't want a 720, I want a 740 credit score. Mm-hmm. And I won't take a 43 DTI, I want a 41 DTI. And on top of it, I want 75 LTV, not 80 LTV. But if you bring me that, I'm going to offer a 3.5% interest rate, not a 4.25%. Okay. Yeah. Well, now some of Fannie and Freddie's business is going to slide over to the private market. Mm-hmm. Well, if I'm Fannie and Freddie and I'm looking at my bottom line, I'm looking at my stat sheet, I'm looking at my analytics, and I don't like what's transpiring, it's going to force me to be more competitive. If I have to be more competitive, maybe I'll open up my credit box. Maybe I'll make my pricing a little bit more aggressive. Now we have competition. This is if you're Mark Calabria and you're the FHFA and you're the one creating this rule, right, all through the senior preferred stock purchase agreements, this is your ideal situation. This is what you want to happen. Yeah. Okay. You may also have someone who comes in and they're like, look, I'm going to charge the same exact rate as Fannie and Freddie. Okay. Same exact, but I'll do a 680 credit score. But I'll do a 45 DTI. But I'll do a LTV of 85 or 90. Mm-hmm. Okay. If too much of that business starts going to Fannie and Freddie, again, maybe there'll be a competition. That's ultimately what those that have signed off on the 7% rule, it's what they want to see.
Gotcha.
All right. So one thing that really isn't getting a whole lot of news that should get a whole lot of news, and it kind of correlates to these changes that are going on in terms of Fannie and Freddie saying, okay, it's been over a decade. We are sick and tired of being the only game in town.
Yeah.
Okay. It's in their most recent lender letter.
Okay.
There are 3 attributes of loans that they don't like: high LTV, low FICO, and high DTI. Okay. All right. So loan officers, realtors, people who are going to be borrowing money sometime in the next 12 to 36 months, buying your first house, buying your second home, what have you. This applies to all of you. Okay. We already know that if you want to get the best terms and have the most options for lending, you want to have high credit, low loan to value, and you want to have a low DTI. And ultimately, you want to have at least 2 out of the 3. Yeah. Well, Fannie and Freddie have come out, at least Fannie has. I always say Fannie and Freddie, the two go together. Yeah. Fannie was first, Freddie was second. We always they technically compete against each other. So this is good to know. Yeah. They technically compete against each other, but they had the same parents, right? They're still in conservatorship with the FHFA. They both were always quasi-government agencies. And just recently, you used to be able to deliver a loan in the secondary market. One could have been to a Fannie mortgage-backed security. One could be a Freddie. Now it's unified. Okay. Uniform. The U, it's a UMBS. I should know this, damn it. I'm a CMB. Today, it's uniform, unified. Just know they combined.
Okay.
And it tends to be if Fannie does something, Freddie's going to follow suit. Okay. And vice versa, especially if it's something as large as a 7% rule. Gotcha. So we tend to loop in Fannie and Freddie, but they are separate. Right? They're brother and sister, or stepbrother, stepsister, half brother, half sister, however you want to think of it. Okay. So when I say Fannie and Freddie, honestly, I'm referring a lot to Fannie right now because Fannie's the one that's come out and made the news and made the waves. Gotcha. We anticipate Freddie Mac's going to follow suit. Okay. So I was talking about LTV, DTI, and FICO. Yep, credit score. Yeah. So we've always known in the industry it was a great rule of thumb that you wanted to have high credit score, you want to have low debt to income ratio, and preferably you want to be putting some money down, some skin in the game. Mm-hmm. And it started in 2018 where if you were trying to utilize down payment assistance, that means no skin in the game for the consumer. Okay. You need to be more squeaky clean starting in 2018 versus 2017 and years prior. Meaning good luck running a down payment assistance loan through Fannie Mae's automated underwriting system where you had a lower FICO and a higher DTI. Okay, well, just recently, Fannie has come out and they have stated for all loans, not just down payment assistance loans, for all loans, that they are only going to be willing to accept 1 out of these 3 criteria. So they're cool if your DTI is 45 or higher, as long as your credit score is above 680, and as long as your LTV is below 90.
Okay.
They're totally cool with your LTV being above 90, as long as your DTI is below 45, as long as your FICO is above 680.
Okay.
And they're cool with your credit score being below 680, as long as your LTV is below 90 and your DTI is below 45.
But
they're not cool with 2 out of 3. Okay, so these are the 3 things that they're not, that they have red flags on, warnings. It was kind of like, took my son on a hike when we were in Hawaii. We hiked down to the lava rocks where they meet the ocean, and there is a really cool blowhole. A blowhole is kind of like a geyser, right? Utilizing ocean water and lava rock. And there's a big sign that says, warning, danger ahead, do not proceed. Okay, Fannie Mae has stated, these are the warning signs. A FICO below 680, credit score below 680, a DTI above 45, and an LTV above 90. They're cool with 1. They're not cool with 2. They sure as hell won't take all 3.
Yeah.
Yep. So if you have 2 of those 3 factors, just a month ago or 2 months ago, you very well could have run a 660 credit score through Fannie Mae's desktop underwriter with a 46 DTI and received an approved eligible.
But now,
no thank you. No, you need to get either your LTV down or your credit score up. So any combination, originators, you got to know this, because we are going to get so many questions here at the branch level where an LO is going to run something through LPA or DU, and they're going to be like, oh, DO, what's going on? Or they're going to go to their manager. What's going on? I can't get an approved eligible. I'm like, well, do you have 2 of those 3 qualities?
Oh, yeah.
Is your FICO below 680? Is your DTI above 45? Or is your LTV above 90? If you have 2 out of the 3, that loan's not going to go through. Guess what? FHA is a great choice for that person, especially when they're buying a primary home, especially when their loan amount is under your area's maximum FHA loan amount.
Yeah.
Right? Like, FHA is a great product. We have gotten we've gotten away from that over the past 3 to 5 years as an industry. We should start looking towards FHA. Realtors, homebuyers. This is every reason why you have to talk to a lender early on in the process. Because if your DTI is over a 45 and your credit score is under a 680, if you and your loan officer have enough time, can you put together a game plan that'll allow you to fix one of those 2 things?
Yes, that sounds like
right. I mean, are there a couple things you can do to get that credit score from a 670 to a 690? Probably. Pay your credit cards down.
Yeah.
Maybe you have a couple small credit cards that are showing as maxed out. Right. These are some things that when we had Credit Christie on almost a year ago now, that she was teaching, about best practices when it comes to credit. And as a loan officer, this is why we teach you have to be a proven, intelligent professional. Like, there's no such thing as a one-size-fits-all mortgage. Consumers are going to have to work with their loan officer earlier and more often up front in order to put themselves in the best position to qualify.
All I hear is opportunity. If I'm a loan officer, all I hear is opportunity to educate yourself on this, to sound smarter. Because just by listening to you, I feel like I could go out somewhere and be like, actually, did you know the guidelines recently changed on that?
Oh, hey, loan officers, you should be teaching lunch and learns right now to your realtor and builder partners. They need to look at you as the expert. You have to know this stuff. You have to know, how could you get someone's DTI down? How could you get someone's credit score up? Look, the LTV, that's hard to solve for. Like, I don't know how you help someone find more money, but you sure as heck can help someone get their credit score up. Right. And you can also help. I think credit score is the easiest one, honestly. Yeah. DTI, it's like, look, it's going to take a little bit of money to do DTI, but there's some tricks in the bag, right? Someone like Credit Christie can talk to someone about how they could go refinance their car loan, get a cheaper car payment that'll lower their DTI, right? Maybe instead of putting down 10%, you put down 5%. By putting down 5%, you're able to pay off some debt now that you get the debt load down. Maybe you want to utilize borrowing against your 401k for your down payment, but maybe the cash you have saved you use to pay off some debt to get your DTI down. Like, there's some things that consumers can do. Yeah. But this is why I don't think you could just go to a call center to get a loan.
Right.
This is why realtors refer certain loan officers in the marketplace and why they try to get home buyers talking to lenders early in the process so that, look, if you're looking to buy in 9 months, that doesn't mean do your pre-approval in 8 months. That means talk to a lender today.
Yeah.
Make sure that you could qualify. And if you can't, what are some things that you can work on?
Yeah.
So that's kind of what's going on in the landscape of conventional financing. Because look, Fannie and Freddie is just conventional, right? This is not impacting VA loans, FHA loans, and USDA loans. By the way, you can't utilize FHA, VA, or USDA to purchase second homes or an investment property. We've done shows on this as well. Mm-hmm. But this is what's going on in the conventional landscape. There's a reason behind it, right? Why? Like, historically speaking, what transpired, what's the future, both of Fannie and Freddie, as well as our industry. I'd encourage everyone to educate themselves. Mm-hmm. The Mortgage Bankers Association, they have School of Mortgage Banking. You can do School of Mortgage Banking 1, 2, and 3. You can become an accredited mortgage professional. You can parlay that into becoming a CMB. A CMB is, to me, the highest designation you can achieve as a mortgage professional, at least from a academic standpoint. Mm-hmm. You can get involved in the National Mortgage Bank, the National Association of Mortgage Brokers. You can get involved in the Mortgage Bankers Association. You can, you can
listen to this podcast.
You can listen to this podcast. No, but you can subscribe to Rob Chrisman. You can follow Dave Stevens. There's a lot that you can do. Read HousingWire. There's a lot that you can do to make sure that you're on top of your game and you're truly understanding the why. Yeah. Look, the experts are going to debate whether this is too much too soon. We, as an industry, me as Dustin Owen, I'm going to let Dave Stevens publish what he publishes in HousingWire, then I'm going to read it. Mm-hmm. I'm going to let Bob Broekschmidt, who is the president of the Mortgage Bankers Association, and his team lobby Congress on behalf of my industry. But I'm going to follow what they're doing, and then time will tell. Yeah. But as an originator, as anyone tuning in as a home buyer or a realtor, this is my take of what is transpiring. This is how I understand it. Mm-hmm. I am by no means a policy maker. At the end of the day, I'm a loan officer. I'm a loan officer at heart. I'm someone today who talks about the mortgage industry. I teach about being a top loan officer because I once was one. And along with two of my two business partners, I run a very large mortgage operation in the state of Florida, mm-hmm. right? But please know that anything I talked about today is how I understand it, and how I've read it and how I've regurgitated it. By all means, it's not the Holy Grail. So I encourage you to become a student yourself. Yes. If you like what we're doing, please share us. Please like us. Mm-hmm. Please give us a review. Mm-hmm. Follow us. Mm-hmm. Hit us up on Instagram, on Facebook, on LinkedIn, on YouTube. Mm-hmm. You can subscribe to our YouTube channel at The Loan Officer Podcast. And hit us up. Email John, email me. We'd love to hear from you. Yep. This is all we have today about this topic. If there's something else you want to hear us do, by all means, recommend it. Yep. John will add it to the agenda. We will do our best to make it a priority. Yep. He's John Coleman. I'm Dustin Owen, and we're out.
Peace.